This session is a comprehensive description of DSCR, debt service coverage ratio, loans, including what they are, how they work, their benefits, eligibility criteria, risks, and how they compare to other loan types. The focus is on clarity, depth, and practical understanding for real estate investors, particularly in the U.S. Debt service coverage ratio, DSCR loans, a comprehensive overview. In the world of real estate investing, one of the key challenges investors face is securing financing that aligns with their income structure. Traditional mortgages typically require proof of personal income through pay stubs, W-2 forms, or tax returns. However, many real estate investors operate through a business entity or rely on rental income rather than a steady paycheck. For these borrowers, a DSCR loan, short for debt service coverage ratio loans, offers a more flexible and investment-focused financing solution. A DSCR loan allows lenders to qualify borrowers based on cash flow generated by the property itself, not the borrower's personal income. This makes DSCR loans an ideal option for real estate investors, self-employed borrowers, and those building a portfolio of rental properties. What is DSCR? The term debt service coverage ratio, DSCR, is a financial metric that measures a property's ability to cover its debt obligations. In simple terms, DSCR compares the property's net operating income, NOI, to its annual debt payments, principal, and interest. The formula for calculating DSCR is DSCR equals the net operating income, NOI, divided by the total debt service, where net operating income, NOI, equals gross rental income minus operating expenses, including mortgage payments. Total debt service equals annual loan payments, principal, and interest. A DSCR greater than 1.0 indicates the property generates enough income to cover its loan payments. A ratio below 1.0 means the property's income is insufficient to cover the debt in full. For example, if a property generates $60,000 in NOI annually, the annual loan payment is $50,000. So that's a DSCR is 60,000 divided by 50,000 equals 1.20. This means the property earns 20% more than needed to cover debt obligations. DSCR loan concept. A DSCR loan is a type of non-QM, non-qualified mortgage loan that evaluates the borrower's ability to repay based on the property's DSCR rather than their personal financial statements. In practice, lenders focus on where the rental income from the property can support. Let me repeat that. Lenders focus on whether the rental income from the property can support the mortgage payments. These loans are typically used for investment properties, not primary residences. The logic is simple. The property itself should pay for its financing. Key characteristics for DSCR loans. Qualifications based on property cash flow. Personal income verification such as tax returns is not required. Used for investment properties usually applies to 1 to 4 unit residential units, multifamily units, or commercial buildings. Flexible ownership structure. Borrowers can close in their personal name or through an LLC or corporation. Credit based on income. Credit score matters, but traditional income documentation is replaced by rental analysis. Ideal for portfolio investors. Investors can expand holdings without overextending personal debt to income ratios. How DSCR works. Step 1, property evaluation. The lender determines the potential or actual rental income of the property. This may be based on a current lease agreement for occupied properties or a market rental appraisal, Form 1007, if the property is vacant or newly purchased. Step 2, expense assessment. Lenders estimate operating expenses such as property taxes, insurance, management fees, maintenance, and utilities to calculate net operating income, NOI. Step 3, DSCR calculation. The lender divides the property's NOI by the annual mortgage payment to find the DSCR. Each lender has minimum ratio requirements. Step 4, loan qualification. If the DSCR meets or exceeds the lender's threshold, often 1.0 to 1.25, the borrower may qualify for the loan. The higher the DSCR, the stronger the application. Step 5, underwriting and closing. Underwriting focuses primarily on the property's income, credit score, and appraisal value, not personal debt ratios or employment verification. Typical DSCR requirements. Each lender sets its own guidelines, but common standards include minimum DSCR, 1 to 1.25. Some accept lower with higher interest rates. Credit score, 620 to 680 minimum, higher for better terms. Down payment, 20 to 25%, up to 30% for lower DSCR or cash out refinances. Loan purposes, refinance or cash out refinance. Property type, 1 to 4 unit, residential, condos, townhomes, multifamily, or mixed use. Ownership, individual or entity such as an LLC, partnership, or corporation. Loan terms, 30-year fixed, ARMs, or interest-only options. Documentation, lease agreement or market rent appraisal, property insurance, title documents, and credit report. DSCR ratio tiers and their impact. Lenders use DSCR tiers to determine risk and pricing. Generally, a DSCR greater than 1.25 is excellent. Property generates strong cash flows. Borrower qualifies for the best interest rates and terms. A DSCR 1.0 to 1.24 is acceptable. Property breaks even or generates modest profits. Standard pricing applies. DSCR less than 1.0, risky. Property does not fully cover debt payments. Some lenders may still approve, but with higher rates, lower LTVs, or additional reserves. A DSCR of 1.0 means the property's income equal its debt service, essentially a break-even scenario. Example of a calculation. Imagine an investor purchases a rental property for $400,000 with a 25% down payment and a loan amount of $300,000. The loan terms are 30-year fixed at 7%, resulting in an annual payment of about $23,900. If the property rents for $3,000 per month, annual gross rental is $36,000. After subtracting 20% for expenses, $7,200, the NOI is $28,800. So the DSCR, 28,800 divided by 23,900 equals 1.2%. This indicates the property earns 20% more income than needed to service the loan, strong enough for approval. Advantage of DSCR loans: no income verification. Borrowers don't need to submit tax returns, W-2s, or pay stubs. Qualification is based solely on the property's performance, making it ideal for self-employed investors, real estate entrepreneurs, or retirees with passive income. Faster processing. With simplified documentation, DSCR loans typically close faster than conventional loans. Flexible ownership, investors can buy under an LLC or corporate entity, offering liability protection, easier portfolio management. Scalable investment growth. Since personal income and debt-to-income ratios don't limit qualification, investors can finance multiple properties simultaneously. Cash out opportunities. Borrower can access equity through cash out refinancing to reinvest in additional properties or upgrades. Property variety. DSCR loans can apply to single-family homes, duplexes, triplexes, fourplexes, or even small multifamily or mixed-use buildings. Interest-only options. Some lenders offer interest-only payments, maximizing cash flow for the next several years. Disadvantages and risks. With DSCR loans are powerful tools. While they are powerful tools for investors, they come with trade-offs. Higher interest rates. Compared to conventional mortgages, DSCR loans typically have rates from 0.5 to 2% higher, reflecting greater lender risk. Larger down payments. Minimum down payments often start at 20 to 25%, reducing leverage but increasing borrower equity. Stricter cash flow requirements. If a property's rental income is too low, it may not qualify even if the borrower is financially strong. Limited consumer protections. Since DSCR loans are business purpose loans, they are not covered by the same consumer regulations as owner-occupied mortgages, i.e. TRID or QM rules. Market risk. Rental income can fluctuate due to vacancies, economic downturns, or property damage, potentially lowering the DSCR. Refinancing challenges. If a property's income declines or interest rates rise, refinancing options may become more limited. Comparing DSCR to traditional mortgages. Qualifications. DSCR loans are based on property income, the NOI divided by the DSCR. Documentation. Lease agreements, rental appraisals. Traditional mortgages based on borrower's income, the DTI ratio, and documentation, the W-2s, tax returns, or pay stubs. Borrower types. DSCR loans deal with the real estate investors, property use, investment only, interest rates slightly higher, loan regulation, non-QM business purpose, down payment 20 to 30%, entity ownerships are allowed, cash flow focus, central to qualification, speed to close faster. With traditional mortgages, the homeowners or owner occupants are the type of borrower, primary, secondary investment use, lower depending on creditor income scores, so the rates are lower. Loan regulation, QM, consumer protection rules apply on regular traditional loans. Down payments on a traditional loan, 3 to 20% depending on loan type. Entity ownership, typically not allowed. Cash flow focus, secondary consideration. And speed to close on a traditional is slower due to verification steps. Ideal borrower profiles. DSCR loans best suitable for borrowers who own or plan to own rental properties that generate consistent income, prefer business financing rather than personal debt, lack traditional income documentation, i.e. self-employed investors, want to scale a rental property quickly without hitting DTI limits, seeking privacy and want to keep investments separate from personal finances. Common use cases. Rental property purchase. Investors buying new rental properties can qualify based solely on projected rental income rather than personal income. Cash flow refinance allows property owners to extract equity to fund other investments or renovations. Portfolio expansion. Investors with multiple properties can continue acquiring more without being constrained by income limits. Refinance from hard money loan. DSCR loans provide a long-term alternative to expensive short-term investor loans. Short-term rentals, Airbnb. Some investors and lenders allow income based on historical booking statements rather than traditional leases. DSCR loan market and lender landscape. The DSCR loan market has expanded significantly over the last decade, particularly following the growth of short-term rental platforms and the rise of self-employed investors. Lenders include non-bank lenders and private lenders, mortgage brokers specializing in investor loans, portfolio lenders, and specialized DSCR programs within major institutions. These lenders often sell DSCR loans into private mortgage-backed securities, MBSs, pools, or hold them in portfolio accounts. Underwriting flexibility. Since DSCR loans are non-QM, lenders have more discretion. They may adjust criteria based on experience levels of investor, geographic location, loan amount, or property amount. Some even may approve low DSCR loans, less than 1%, if the investor has strong reserves or equity, and that was 1.0 if the investor has strong reserves or equity. Recognize the potential for property appreciation or rental increases. Key metrics for DSCR loan success. Borrowers should focus on maintaining strong investment fundamentals. Target DSCR at 1.25 for healthy cash flow. Budget reserves 3 to 6 months of payments to weather vacancies or repairs. Ensure accurate rental projections via market appraisals or local comparables. Avoid over-leveraging with multiple loans across underperforming properties. Monitor expenses closely. Utilities, maintenance, HOA fees, and taxes all impact NOI. The role of appraisal and rental analysis. Appraisals are central to DSCR underwriting. 1 to 4 unit appraisal properties, lenders often require full appraisal report, Form 1004, and market rent schedule, Form 1007, to estimate fair rental value. If the property is already leased, the lender may use the actual rent if it's consistent with market value. For multifamily or commercial properties, lenders may require a commercial appraisal or income approach valuation. DSCR loan programs and variations. Different lenders offer several DSCR loan products, including standard DSCR 30-year fixed loan, predictable payments, best for long-term holds, interest-only DSCR loans, lower initial payments, maximizing cash flow, adjustable rate DSCR loans, ARMs, lower starting rate but variable over time, low DSCR or non-DSCR loans for strong credit investors willing to pay higher rates, portfolio DSCR loans, one blanket loan covering multiple properties. Each variation suits different investor goals, cash flow optimization, appreciation play, or rapid scaling. Tax and entity consideration. Many investors use LLCs for DSCR loans to limit personal liability, simplify bookkeeping, and take advantage of tax deductions, interest depreciation, repairs, etc. Since DSCR loans are business purpose, interest paid may qualify as a deductible business expense. However, borrowers should consult with a tax professional to structure ownership efficiently and ensure compliance with IRS rules. Future of DSC lending. The DSC lending market continues to expand as housing demand and rental investment grow. Future trends include technology-driven underwriting using real-time rental data and analytics, alternative income models for short-term rentals, increased securitization of DSCR loans, improving liquidity, and standardization across lenders, improving transparency for borrowers. As institutional investors enter the rental market, DSCR loans may increasingly resemble small-scale commercial real estate financing, bridging the gap between residential and commercial lending. Conclusion: DSCR loans have revolutionized how real estate investors access financing. By focusing on property performance rather than personal income, they empower borrowers who operate outside traditional employment structures. These loans simplify scaling, protect privacy, and enable flexible ownership through entities, all while aligning loan qualification with real-world investment fundamentals. However, investors must approach DSCR financing with care. Higher interest rates, cash flow sensitivity, and limited regulatory protections make due diligence critical. Successful borrowers maintain strong reserves, realistic rent assumptions, and disciplined investment strategies. In essence, a DSCR loan treats each property as its own business, one that must generate enough revenue to sustain its obligations. For savvy investors who understand cash flow and risk management, DSCR loans represent not just a financing tool, but a pathway to sustain portfolio growth and long-term creation. This is Bob Gersh with East Coast Capital. If you'd like more information on DSCR loans, or would like just to talk about the topic, or maybe you'd like to apply for one, give me a call at 781-454-7138. Once again, the phone number is 781-454-7138. Look forward to hearing from you with any questions you may have. Have a great day, a great week. Enjoy life. Until next time, thank you.